Welcome everybody to today's video. I want to talk about the types of policies, the types of life insurance policies that there are out there. Now this is just part one, so I'm just going to be going over the two main ones that people know, love, and trust. And it's going to be term insurance and whole life insurance, aka permanent insurance. I'm also going to be talking about straight life insurance, limited pay whole life insurance, single premium policy, and a adjustable life. So what all those things look like, and what's the difference between them. Now, I know there's a lot of people that say, oh, well, whole life is better than term life, or universal life is better than whole life, or term life is better than whole life. It doesn't matter. Just as long as you have policy, just as long as you have a life insurance policy, is what's good. Now, of course, there's going to be better policies that's more suitable for the situation or the predicament or the lifestyle that you're into. But all of these life insurance policies serve a great purpose, and you should have one or two, if you ask me. But so, for the sake of this video, let's go ahead and get into it. So the first one is term insurance. So when you think about term, think about temporary, TT, temporary term life insurance. So what does this temporary word mean? Well, this means that we have coverage for a specific amount of time, and it will expire at the end of the period. So however long you have that term insurance for, you got to remember, it's temporary coverage. So it's going to be 1, maybe 2, maybe 5, maybe 10, 20, 30 years that you're going to have this term insurance in effect. But I will say that this is the least expensive insurance, life insurance that there is, because it's only for a specific amount of time. It's not permanent, and it doesn't build any cash value. So there are many reasons why people have term insurance. Now, if you're somebody that's just starting out your career and your company is the one that I guess inspire you to sign up for life insurance, then you will 9 times out of 10 be in a group insurance, or a group insurance, which we'll talk about later on. But the idea is it's for its temporary amount of time. It's not permanent. So you can convert it anytime you want. You can renew it at the end of the year with annual renewable. So with term insurance, we're going to learn that there are 3 levels of term insurance, and these 3 levels is based off of the death benefit. It's based off of they're all based off of what the death benefit does in the situation. So the first one that we have is level term insurance. Now, when we think about level, we want to really think about what the death benefit is doing. So in level term insurance, the death benefit or the face amount remains the same over the course of the term insurance policy. And we see that right here. So it remains the same for a specific amount of time. And another thing I want to say about term life insurance is it's pure death protection. So it's pure death protection. So the insurance company is protecting you and your losses for a specific amount of time. There's no added on things like cash value or a separate account or a savings account or a investment account that's added onto it. It's just the death benefit and the premium. So yes, with level term insurance, we see that the death benefit remains the same. So for decreasing term insurance, what happens when it's decreasing? Well, it's going down. So we see the decreasing term insurance mostly in mortgages. When you have an individual that is paying off their mortgage or paying off a loan that they may owe, with the face amount. So the face amount is going down. So we have decreasing term, which is primarily for if you're trying to pay off your mortgage. And if you hear some papers turning in the background, that's me. I'm just going through my notes, making sure I cover everything, because I wrote notes down and it's helped me tremendously understand this more better. But yes, so with decreasing term, it's the face amount death benefit decreasing each year over a duration of the term policy. So it's commonly used for insured it's commonly purchased to ensure the payment of a mortgage or any other debt. So you're paying that amount, and every time you pay your premium, the face amount will go down over time. See, the idea of a decreasing term insurance is you want the face amount to be pretty much zero, because that lets you know that you're done paying off the loan or the mortgage. So the next one that we have is increasing term insurance. So what is that? Increasing term insurance is when the face amount goes up each year. Increasing term is mostly used as a rider to increase coverage. So later on in a later video, I will cover riders and provisions and options and settlements and all those good things later on in a different video, just not today. But yes, so with increasing term, it increases, it goes up. The face amount goes up, which is a good thing. And I can see why individuals may use that as a rider, or may put it as a rider. So the coverage on a base policy to offset inflation. Oh, so that's why they would use it. It's coverage on a base policy to offset the inflation. Alright, so what happens at the end of the term insurance policy? What happens at the end of a term life insurance policy? So we know that the life insurance policy is going to end at some point in time, whether it's 2 years, 5 years, 20 years, 30 years, 40 years. It's going to end. I think another reason why people get term insurance is because if it's like a child or a adult child that wants to get term insurance for their elderly parents. So they know their parents aren't going to live past a certain amount of time, but they want their parent to have coverage for a specific amount, a temporary amount of time as they pass, or as the years go by and their health goes down or something like that. They just have a feeling that their parents aren't going to live for too much longer, or it's not going to live to 50 years. So they pull out a life insurance policy, a term life insurance policy, for maybe 30 years, maybe 40 years, to make sure that their parents have coverage. So I meant to say that earlier, but I remembered right now. So that's another reason why people get term insurance. So what happens at the end of the term? So there's two options. There's two things that you can do whenever your term insurance expires. So the first one is you can renew. Term insurance is renewable. And we see that with annual renewable. So they renew the policy before the time or the end of the insurance policy or the term insurance policy. So you want to make sure that you do that before your policy ends. And with renewable policy or annual policy, whatever, you don't need any proof of insurability. You don't need any proof of insurance. So you can go in there and, get with your insurance agent, and they will be more than happy to renew your term for however long you need it. So we see that when we renew, so when we're paying our premiums, and every year we're gonna get older. So when you renew your premium or you renew your term policy, yes, your premium is going to be a little higher because you're going to be a different age. So it's going to renew. So when we have convertible, so with convertible, that's basically being able to change to permanent from being a term insurance. So you're going from term insurance to permanent whole life insurance, which is what we see most of the time, and you don't need any proof of insurability. Now, you have to be mindful that when you convert to whole life, your premiums are going to be more expensive because whole life is permanent and you get cash value, so it's going to be more expensive. So as long as you're okay with that and you're mindful that that's going to happen, then by all means, if you feel that it's time for you to switch to whole life, then do it. So those are some of the special features. So renewable and convertible are some of the special features that we see in term insurance. So with both renewable and convertible, you don't need proof of insurance, which is always a good thing. All right, so moving on to the second main type of life insurance, which is whole life permanent insurance. So it's permanent. So it's this is generally a term that's used to refer to many forms of life insurance policies that build cash value. That's the key thing. It has cash value. It builds cash value, and it remains in effect for your entire life or until you become 100. So it remains in effect the entire life of the insured until they turn 100, as long as the premiums are paid for. So cash value, when you think about whole life, just think, okay, whole life has cash value while term life doesn't. So a possible test question that you could get is, who bears the investment risk on whole life? The insurer. So the insurer bears the investment risk on whole life, which we're going to be talking about, investments and stuff like that later. But whole life provides a lifetime of protection, and this includes a savings account or a cash value. This policy endows covers the insured up until the age 100. So the cash value is created by accumulation of premiums scheduled to and equal to the face amount of the policy at age 100. So that's how we get the cash value. So the cash value is a accumulation of the premiums and the face amount of the policy at 100. So it's going to equal the face amount of the policy at 100. So with whole life, we have some characteristics that we don't really have in term. So in whole life, yes, well, both whole life and term life, we have a level premium, yes, and we also have a death benefit. But the two biggest differences from whole life to term is the cash value and the living benefit. And we're going to be talking about living benefit here in a later video. But those are the big two main things that whole life has over term life. It has cash value and it has living benefit. And living benefit is a great benefit to have. We're going to be talking about that later on. What is living benefit? Living benefit is like you can do more with that you can't normally do with a IRA or a 401k plan. All right, so whole life policy equals billed cash value, which grows tax deferred. That's awesome. That's awesome to hear. That's why I included it on the slideshow, because that's something that we got to remember with whole life is it grows cash value and that becomes tax deferred. It's not taxed until the money is withdrawn. So, like I said, whole life remains in effect until the age 100, or as long as the premiums are paid, the policy remains enforced. That's awesome. So if the policy is canceled, the cash value is paid to the policy owner, and the policy owner can borrow against the cash value of the policy, but must pay the interest. So you can borrow money out of your whole life policy. The policy owner can borrow money against the cash value of the policy, but they must pay interest. So let's say if you have a whole life policy, you're the policy owner, you're the insured, and let's say you live to the age 100. If you live to the age 100, the cash value is paid to the policy owner, whoever the policy owner is. So if you're the policy owner, then you get the cash value because you lived up to it. So that's your reward for living, until 100 and having a life insurance policy. You're going to get that cash value. That's good. That's very motivational. So the taxes will be due on any amount that the insured received in excess of the amount paid into the policy and the premiums. So with a whole life policy, the insured will receive either the death benefit or the cash value, but not both. So some whole life policies can be categorized off of the length of the premium payment period. And that's where we get into the different types of whole life that we'll have, because there's different levels of whole life. So we have straight life. Straight life is covered with the basic characteristics of whole life, which is the premiums, the face amount, and then we have the cash value. So we got our premiums, which is level, our cash amount or our cash value, which is going to increase because That's what happens with our cash value. The more premiums that we pay, the more cash or cash accumulation that occurs. The face amount is going to be the same. But so with straight life, you're pretty much going the whole way through. You're setting it for age 100. So the policy owner will pay the premiums from the time of the policy. So the time the policy is issued until the insured dies or they become 100. Straight life will have the lowest annual premium out of the three kinds of over the three or the four different types of life insurance policies that we're going to talk about. So straight life insurance or straight life whole life is pretty much setting it to 100. I plan to live to the age 100. I'm going to be paying my premiums. My cash value is going to be increasing, but my death benefit is going to be the same. So I will either get a award that, cash value whenever I turn 100, or my beneficiary will be awarded the death benefit whenever I die. And remember that straight life will have the lowest the lowest annual premiums. And straight life is continuous. It doesn't stop. It goes the whole way through. It's continuous. It's not like limited pay whole life or limited whole life insurance. So limited is like what it says. It's for a specific amount of time. So it's completely, you want your policy or your premiums completely paid up well before 100. So there is going to be an annual premium higher than straight life because you're trying to get it all completed underneath 100 years. So yeah, with limited, you're setting it for a specific amount of years. So let's say if you have 20-year life insurance policy. So let's say I'm 40 years old. I do a limited whole life insurance policy for 20 years. So I have to pay a 20-year policy that gets paid up in 20 years. So even though my policy premiums got paid up within 20 years, my policy would still be enforced for 100. So it would still, so as you can see, look, here's what we see. My cash value will still go up, but I'm going to be paying more for my premiums because I'm trying to pay my premiums up in a specific amount of time. So that's why my premiums are higher, will be higher here than compared to straight life. Because I'm trying to get it, with limited life, I'm trying to get it paid up within a certain amount of time, so my premiums would be higher. But the reason why it would still be enforced is because if we look right here, we see face amount, death benefit. The lines don't stop, at the paid up age. My lines continue to go up into the 100-year age. So both my cash value and my face amount death benefit is continuing to be enforced way beyond me paying up my premiums. So that's a visual representation is what I'm talking about. All right, so when we have single premium policy, now this one is a little bit weird, but some people do it. Some people have enough money like that. They got bread like that to just drop a lump sum, one lump sum premium. So entire premium is paid up in one lump sum, and they have life insurance forever with one single premium, and it will build cash value immediately, of course, because you just dropped a whole lot of money in one premium payment, and the cash value is going to increase immediately. Like, it's going to be like boom. It's going to be so fast. Single premium, we don't, a lot of people may not do that because not everybody just has, like 70 grand or 10K just laying around to go spend on some life insurance. Get a single premium policy just like that. So when we see that, we automatically know that their cash value went up instantly. It has immediate cash value. It's one-time payment. So the death benefit was designed to provide a level death benefit to the insured up to the age of 100. Yep. So the cash value would go immediately up, though. Will go up faster because you just dropped a big sum. So the next one that we have is adjustable life insurance. So with adjustable life insurance gives the policy owner ultimate policy flexibility. So when I was first getting taught this concept, the professor that taught me this had us think about selling life insurance or being in the sales industry or being in the life insurance industry. There are months when you make way more than you will make on other months, like 3, sometimes 4 times as much as you make in 1 month. So your income is not consistent. So with adjustable life insurance, it gives you more leeway to maybe miss payments, but maybe still have enough to have that policy be enforced, to increase or decrease your face amount, or change the period and time you have protection, or increase or decrease the premium or the premium paying period. So you get more flexibility. So it's like having the best of both worlds, from term to permanent coverage. You have the best of both worlds. So this policy can be either term insurance or permanent insurance. The insurer determines how much coverage is needed. The insurer will determine what kind of insured is met. What kind of insurance meets the needs of the insured. That's what I was trying to say. So the policy owner can do all of the following. He can and she can decrease or increase the premiums, decrease or increase the face amount, and they can change the period of protection. So they can do a lot more than what they can do with just term insurance or just whole life. So adjustable gives the policy owner that flexibility. So a lot of the times we see life insurance agents or people that sell or people that run businesses, they choose adjustable life insurance. People that are in the service industry choose adjustable life insurance a lot of the times because of the flexibility that you get that you can't necessarily get with term. Alright, so here's just a little table that is comparing the difference between term life insurance, and whole life insurance. Term, remember, is temporary. Whole life is permanent. It lasts until the age 100. Term premiums are leveled, and whole life premiums are leveled. So that's a similarity. The death benefit with term insurance goes up and down. The death benefit with whole life remains the same. The living benefit, we don't have any living benefit available for term life, but with whole life we have living benefits. We have our cash value that we can use. We have policy loans that we can use. We have non-forfeiture. I always butcher that word, but you know what I mean. We have those values that we can use. So we have different living benefits that we can choose from. So guys, that pretty much completes the video part 1 of types of life insurance policies. The two main types is term life and whole life. Remember that. If you're studying for your exam, I wish you all of the best luck. We need more licensed professionals out there. And with that being said, y'all, I'll see y'all on the next video. Peace.